London was changing. The streets were filling with merchants. Ships arrived constantly, carrying goods from every corner of the world. Silks from Asia, sugar from the Caribbean, tobacco from America, precious metals, exotic spices. Every new trade route created opportunities for wealth. And wherever there's an opportunity to make money, investors willing to take risks soon appear. The experience gained in cities like Amsterdam had already proven something important. When many people could contribute capital, it became possible to finance projects on a much larger scale. The idea worked, and more people wanted to be part of it. There was just one problem. Business was still being conducted in improvised places.
Inns,
Public squares,
markets,
coffee houses. There was no formal structure.
there was no centralized system.
But that was about to change. One of the most famous examples occurred in the 18th century. An episode known as the South Sea Bubble. The story began with enormous promises. The company claimed it would generate massive profits through international trade. Investors became excited. The stock price began to rise. Then it kept rising. And it rose even higher. People watched prices climb week after week. Many believed they had discovered an endless source of wealth. People from every social class began investing. Some invested their entire savings. Others borrowed money to buy shares. Optimism seemed unstoppable. But there was one problem. Expectations were growing much faster than the company's actual results. And sooner or later, that gap had to become obvious. When investors began to doubt, the excitement disappeared. Prices started falling. Then they fell even further. And eventually panic took over. Thousands of people lost money. Entire fortunes vanished. The market learned a lesson that history would repeat many times. Prices can rise quickly,
But they can fall just as fast.
as stock exchanges grew, public interest grew with them. More and more people heard stories about investors multiplying their wealth. Some bought shares in trading companies. Others invested in shipping businesses. Others financed industrial projects. The possibility of making money attracted thousands of people. But along with opportunity came problems. Because not every project was worthwhile. And not every entrepreneur was honest. Many promised extraordinary profits. Some exaggerated their chances of success. Others simply deceived investors. Financial history became filled with examples of enthusiasm overpowering reason. People bought without truly understanding what they were buying. They invested because everyone else was investing. They followed the crowd. And when enough people do that at the same time, the consequences can be enormous. One of the most famous examples occurred in the 18th century. An episode known as the South Sea Bubble. The story began with enormous promises. The company claimed it would generate massive profits through international trade. Investors became excited. The stock price began to rise. Then it kept rising. And it rose even higher. People watched prices climb week after week. Many believed they had discovered an endless source of wealth. People from every social class began investing. Some invested their entire savings. Others borrowed money to buy shares. Optimism seemed unstoppable. But there was one problem. Expectations were growing much faster than the company's actual results. And sooner or later, that gap had to become obvious. When investors began to doubt, the excitement disappeared. Prices started falling. Then they fell even further. And eventually panic took over. Thousands of people lost money. Entire fortunes vanished. The market learned a lesson that history would repeat many times. Prices can rise quickly,
but they can fall just as fast.
Financial crises did not destroy stock exchanges. In many ways, they made them stronger. Every mistake helped improve the rules. Every failure inspired better oversight. Every disaster forced markets to evolve. Gradually, more professional practices emerged. Companies began providing more information. Investors learned to analyze risk more carefully. And governments started recognizing the importance of organized financial markets. The stock exchange was no longer just a gathering of merchants. It was becoming a fundamental part of the economy. Companies needed capital. Investors sought opportunities. And the stock market connected both worlds. It became a bridge between people with ideas and people with money. While London strengthened its financial position, something equally important was happening across the Atlantic. The British colonies in America were growing rapidly. Cities expanded. Trade increased. The economy developed. And eventually a new nation would emerge. The United States of America. At first, the country was small compared to the great European powers. But it had something special. Enormous growth potential. Vast land. Abundant natural resources. A rapidly expanding population. And an extraordinary entrepreneurial spirit. As the economy grew, so did the need to finance businesses. Companies. Infrastructure. Canals. Railroads. Industries. Everything required investment. And that meant an organized financial market was becoming essential. The story of Wall Street began in an unexpected way. In the 17th century, Dutch settlers built a wall in what is now Manhattan. Over time, the nearby street became known as Wall Street. Decades later, that name would become one of the most famous in the world. In the late 18th century, a group of brokers began meeting to trade financial securities. They wanted clear rules. They wanted trust. They wanted an organized marketplace. In 1792, they signed a historic agreement, known as the Buttonwood Agreement. The name came from the buttonwood tree beneath which some of those meetings took place. At first glance, it looked like a modest document, but its impact was enormous. Many consider it the birth of the New York Stock Exchange, an institution that would change global economic history. During its early years, the American market was small, very small compared to Europe. But the country was growing at an incredible pace. Every new city needed roads. Every new industry needed financing. Every new business sought investors. Opportunities appeared everywhere. and financial markets expanded alongside them. Railroads played an especially important role. Building thousands of miles of railroad tracks was incredibly expensive. No single entrepreneur could do it alone. Huge amounts of capital were required. The solution was to issue shares. Thousands of investors bought ownership stakes. And thanks to that capital, massive railroad networks were built. The stock market literally helped connect the nation. Investors began to realize something fascinating. When they bought shares, they weren't simply betting on a company. They were investing in the future, in growth, in innovation, in new technologies. Every share represented a small piece of a much larger story, a story of progress. And the United States was full of stories like that. Factories produced more. Cities expanded. The population grew. Productivity improved. The economy advanced. Everything seemed to suggest that the future would be bright. But economic history rarely moves in a straight line. And the larger the market became, the greater the risks became as well. During the 19th century, new industries emerged. Steel, electricity, telecommunications, modern manufacturing. Visionary entrepreneurs built enormous companies. Some would become legendary names. Investors watched closely. Many realized that owning stocks could become a powerful way to build long-term wealth. It was no longer just about maritime trade. Now people could invest in companies capable of transforming society. The stock market was beginning to finance innovation. And innovation was transforming the world. Meanwhile, news began traveling faster than ever before. The telegraph made it possible to transmit information in a matter of minutes. Something unimaginable just a few decades earlier. Markets reacted more quickly. Investors could make better informed decisions. Opportunities multiplied. But so did the risks. Because when information travels faster, emotions do too. Fear spreads quickly. Excitement spreads just as fast. And markets can change direction in a matter of moments. It was a new era for finance. An era where information itself was becoming one of the world's most valuable assets. As the 19th century came to an end, Wall Street was no longer a local curiosity. It was becoming a global financial powerhouse. Companies of every size turned to the market for capital. Investors searched for new opportunities. Newspapers published stock prices every day. The public became increasingly familiar with stocks. The stock market was becoming part of everyday life. And what happened over the following decades would forever change the relationship between people and money. Years of extraordinary prosperity were ahead. Moments when it seemed wealth could grow without limits. But historic crises were coming as well. Market crashes that would shake entire economies. Events that would once again prove the market can reward patience, but it can also punish recklessness. And among all those stories, one episode would become one of the most famous in financial history. The Great Boom of the Roaring '20s. A time of overwhelming optimism. A time when millions believed stock prices would rise forever. A time that would ultimately lead to one of the greatest economic disasters the world had ever seen. In the next part, we'll discover how Wall Street conquered the world, how modern investing culture was born, and how the crash of 1929 permanently changed the rules of the financial markets.